Hi everyone. In the previous video, we talked about the profit margin. In this video, we're going to discuss the current ratio and do some calculations. The current ratio is a liquidity ratio shown at the back of Chapter 3 in your textbook. It helps to assess a company's ability to pay its debts in the near future. The ratio is calculated as follows. Current assets divided by current liabilities. Now, you and I have not discussed current assets and current liabilities, but there is a really good explanation of current assets and current liabilities in your textbook in Chapter 3. But let's go ahead and define current assets and current liabilities on this video, just so everybody's up to speed. Current assets are cash and other assets that are expected to be sold, collected, or used within 1 year, or the company's operating cycle if longer. The study of companies that have an operating cycle longer than 1 year is outside the scope of this class, so for purposes of this class, we will consider current to be a period of 1 year beyond the balance sheet date. Examples of current assets are cash, accounts receivable, merchandise inventory, supplies, short-term investments, and prepaid expenses. Now, there have been examples in the textbook that say something like the company paid for 3 years of insurance in advance. And that's kind of unusual. Companies don't normally pay years' worth of expenses in advance. They might pay a few months' worth of expenses in advance. So, you may assume that a prepaid expense is a current asset unless you are specifically told that more than 12 months have been paid in advance. Current liabilities are liabilities due to be paid or settled within 1 year of the operating cycle, whichever is longer. Again, for purposes of this class, we will consider current to be 1 year beyond the balance sheet date. Examples of current liabilities are accounts payable, wages payable, notes payable that are due within 1 year, and unearned revenue. Again, you may assume unearned revenue is a current liability unless specifically told that more than 12 months have been received from a customer in advance. I've prepared an adjusted trial balance for Jameson Company for the year ended December 31st, X1. I'm going to show you some questions, and then as you're calculating the answer for each question, I will move the screen so that you can freeze it on this trial balance. That way you don't have to write down everything you see in this trial balance. So I'll be moving the screen up and down. Please don't pause your video as you answer a question until I get the screen back at this trial balance. So let me move down for the first question. I want you to calculate Jameson's current assets as of 12/31/X1. So using this trial balance, pause your video, calculate Jameson's current assets, and then start the video again to check your answer. Jameson's current assets consist of cash, accounts receivable, supplies, and prepaid insurance for a total current assets of $7,360. That's 4050 plus 1400 plus 1300 plus 610. Equipment is not a current asset accumulated depreciation on that equipment is not a current asset. Now please calculate Jamison's current liabilities as of December 31st, X1. Again, use this trial balance to calculate Jamison's current liabilities. Please pause the video to do your calculations, then start the video again to check your answer. Jamison's current liabilities consist of accounts payable, wages payable, and unearned fees revenue for total current liabilities of $4,940. That's $3,480 plus $1,000 plus $460. Obviously, long-term note payable cannot be considered a current liability. It specifies that it's a long-term obligation. So given the formula that current ratio equals current assets divided by current liabilities, please calculate Jamison's current ratio as of 12/31/X1. Please do not express your answer as a percentage, but do round your answer to 2 decimal places. Please pause the video, do your calculations on a piece of scratch paper, and then start the video again to check your work. Did you get 1.49? Total current assets of 7,360 divided by total current liabilities of 4,940 equals 1.489. This 9 causes this 8 to go up 1, which means it rounds to 1.49. This means that for every dollar of current liabilities, Jamison has $1.49 in current assets. That's a relatively strong position for a company. They have almost 50% more in current assets than they have in current liabilities. Well, that's all for the ratio videos. Come back for more videos to review for journal entries and adjusting journal entries that will be covered in the exam. Number 1. See you next time.